Josh, welcome. Josh, private markets are evolving. How do you think that increased consolidation and investors branching out into new spaces, how do you think that's going to play out on the wider landscape?
The first fact to be aware of is that private markets have absolutely exploded at the expense of public markets. I think about 3 or 4 years ago was the first year that the private high yield market was actually larger than the public high yield market. And if you look at bank debt, banks are getting disintermediated by the private credit market. If you look at public equities, the number of publicly traded companies has declined precipitously over time. So private markets, for a variety of reasons, including avoiding some of the regulatory frameworks that surround public markets, have absolutely exploded in size. And what that has meant is that different players in our various credit-related industries have adapted differently, and some of them have taken that as an opportunity to grow at a pace that we've never seen before. So they've really hyperscaled from 10, 20, $30 billion families of funds to being half a trillion or a trillion or multiple trillions of dollars in assets. And that changes supply and demand for credit in a variety of different ways in a variety of different markets.
Fast forward 10 years, let's say, and you and I are sat here again. What will we be talking about? What trends will stick? What will be the focus, I suppose?
I do think that there will be a continued trend toward less regulated, maybe slightly less leveraged, so less critical to the financial system types of players taking continuing increases in market share from more regulated types of players. I think that the private to public trend has been going on so long. I don't see that changing. I do think that some of the very largest private credit players, you'll start seeing leave the type of private credit they've been doing so far because there's just not as many deployment opportunities, and maybe migrate up the credit curve toward investment grade, up the credit curve toward rated paper, lower yield, higher volume. It's simply an easier way to put massive volumes of capital to work when you're trying to have growth, but you already have some very, very large asset base because those markets are enormous.
You talk about the bigger players, but say you are a business looking to scale up. How do you maintain that balance between that growth, but also offering the tailored solutions that investors are increasingly wanting right now?
That's a very good question. And it's an art. It's not really a science. There's an inevitable desire to grow because it's how you grow your fee base, it's how you grow the value of your own firm. But there's a niche available in the market for those who are willing to grow with the markets, but not grow so fast that they become simply beta producers. And I think that's a balance. And you have to do what's true to you as an investor. Some firms have done just an excellent job at hyperscaling, and that's a business. That's a real model, and it's a good model for those businesses. And it was a very good model for the investors, maybe a little less good than it was in the past. But there's a reason why you hear certain players talking a lot about investment grade, because at a certain size, that is the way you can continue to be a value-added player for your clients.
Hmm. Josh, thank you so much for your time.
Thank you very much.